Hey everybody, this week on the Business Owner's Corner, I want to cover a potential tax saving strategy that could save you a couple $1,000s or more in taxes if used appropriately. The name of the maneuver is called the SALT Deduction Workaround. And here's the background. SALT is an acronym, stands for state and local taxes. And if you recall how our itemized versus standard deductions work, every year when you file your taxes, your personal taxes, that is, you add up the total amount of itemized deductions that you have. And generally, that includes mortgage interest, state and local taxes, and gifts to charity. Now, you might recall a few years ago when President Trump was in office, he passed a bill called the Tax Cut and Jobs Act. This was at the end of 2017. It became effective in 2018. Prior to that bill, we were free to deduct all of our state and local taxes paid on our federal returns. That bill limited state and local tax deductions to $10,000. True for single filers, true for married filers, $10,000 limit no matter what. So here's an example. Let's say you make $300,000 a year in taxable income and you live in a state like California, like I do. California taxes your income at about 10%. So if you make $300,000 in taxable income, you pay 10% of that to the state of California. That's $30,000. Well, you get to deduct that on your federal tax return, but only the first 10,000. The other 20,000 just kind of evaporates. So since this bill was passed, blue states around the country were not terribly happy about it. And if you think about it, it was a little punitive to blue states in the first place because those are the states that have income taxes in the first place. Your red states like Florida and Texas don't have income taxes, so it doesn't hurt them as much. So since then, the states have organized around this. There was an IRS ruling that permitted a workaround, and the states individually, a lot of them have passed laws that provide a way to work around that limitation. That's what the SALT deduction workaround is. In California, the or it was Assembly Bill 150 was passed last year. In Oregon, we have a bunch of clients in Oregon too. It was Senate Bill 727, I believe, that passed this workaround. Here's how it works. If you make $300,000 a year, what the workaround allows you to do is cut a check to the state for the amount of tax that you expect to pay that year as an individual. And the state counts it as a legitimate business expense and business deduction. So back to our example, $300,000 of taxable income, rather than paying $30,000 to the state of California, only getting to deduct 10, your business could cut a check for $30,000 to the state of California. That $30,000 is then credited to you as an individual, as the owner of the business, as a credit toward your personal tax liability to the state for that year. And effectively, what you've done is reduced your taxable income from $300,000 to $270,000. And rather than deducting only $10,000 of it on your federal return, you get to use the full $30,000 as a legitimate business deduction. So it has a lot of potential here. In this circumstance, if you're making 300 grand a year, you're in the 24% tax bracket, an extra $20,000 deduction is a lot of money. It's almost $5,000 in tax savings just by doing this. Now, at this point, as I cut this video, I believe there are 22 states across the country that have passed similar bills, but the specifics and the logistics of each one vary. So if you've not heard about this, if you're not doing it and you think you might be interested, go talk to your accountant about it because it could save you thousands of dollars in taxes if done successfully. You should know that you have to own a pass-through business. C-corps do not benefit from this at all. It has to be a pass-through business like an S-corporation or an LLC. And as I say, there are state specifics across the board.